Imagine you put $2,000 into a Uniswap pool, half in ETH, half in USDC. Then ETH doubles. You expect your position to be worth $3,000. Instead, you withdraw $2,828. That missing $172 didn't go to fees, it didn't go to the market. It went to a mathematical reality called impermanent loss. In the next 10 minutes, we'll derive the formula and show why a single equation, x times y equals k, replaced Wall Street's order book with a hyperbolic curve. Wall Street spent a century perfecting the order book, an intricate dance of buyers and sellers matched by centralized exchanges. Then DeFi arrived and replaced all of it with 6 characters. X times y equals k, a pool of 2 tokens locked together in a smart contract, ETH on the horizontal axis, USDC on the vertical. The reserves can change, but only in ways that keep their product constant. We call that constant k, and the set of all valid reserve pairs traces out a perfect hyperbola. Let's drop in a real Uniswap pool, 10 ETH, 40,000 USDC. Their product, 400,000. That is our k. Now draw the tangent to the curve at this point. Its slope magnitude is exactly y over x. Here, that's 40,000 divided by 10, 4,000. And that is the spot price, 4,000 USDC for a single ETH. Slide along the curve, and the tangent rotates. The price updates continuously. But here's the twist. Increase the ETH reserve by just 1%. The price does not drop by 1%. It drops by 2, exactly 2. The price elasticity with respect to the reserve is a constant, -2. Reserve shifts by 1%, price shifts by 2. That amplification factor is precisely why trades on Uniswap move the pool much harder than you'd expect. Let's watch one happen. So the curve is a hyperbola. What happens when you actually trade on it? Here's our pool again, 10 ETH, 40,000 USDC. You want to swap 1 ETH for USDC. The smart contract slides you along the curve. ETH goes in, USDC comes out. You receive $3,626, not $4,000. Why less? Draw the chord from start to end. Its slope is the execution price, $3,626. But the tangent at the start had sloped 4,000. The gap is called slippage, 9.3% gone to the curve. And after the trade, the new spot price is 3,307. That is a negative 17.3% price impact. 1 ETH moved the pool by 17%. As for the 0.3% fee, it stays in the pool. K grows, so LPs collect fees on every trade. Then why do they sometimes lose money? Remember the paradox from the opening? You deposited $2,000. ETH doubled. HODL was worth $3,000, but LP was only $2,828. $172? Gone. Here's the math, and the dollars won't lie. When the external price moves to R times the old price, arbitrageurs rebalance the pool. The invariant XY equals K forces the new reserves to X1 equals X0 over root R, and Y1 equals Y0 times root R. Plug these into the pool value. LP value equals 2V0 root R. HODL value, which never traded, is Y0 times 1 plus R. Their ratio, 2 root R over 1 plus R minus 1. That is impermanent loss. Simple, unforgiving. Let's plot it. At R equals 1, the price doesn't move. IL is 0. Not surprising. No price change means no loss. But move away from 1 in either direction, and the curve dives. At R equals 1.25, you've lost 0.6%. A 25% bull run for negative 0.6. At R equals 2, the price doubles. IL is exactly negative 5.72%. That is the missing $172 from the opening. Pure geometry. The formula and the cold open agree because they must. At R equals 4, exactly 20%, 4 times the price, and a fifth of your money evaporated. Here's the beautiful part. IL of R equals IL of 1 over R doubling and halving give the exact same loss. The curve is a smooth U, symmetric in log price, and by the AMGM inequality, 1 plus R is always at least 2 root R, so IL is always non-positive. Fees can offset it, but the IL term itself is always a drag. The only way out, with this curve, is to be smarter about which part of the curve you use. Think back to the last section. Impermanent loss is the cost of holding the entire curve. But look at this pool again. 10 ETH, 40,000 USDC, the whole hyperbola. Most of this curve you never touch. EEH at $100, 10,000, those extremes are pure waste of capital. Most of the pool's money just sits there, earning nothing. In 2021, Uniswap asked a simple question. What if we only use the ARC we actually care about, say $3,500 to $4,500? The math? Shift the hyperbola inward with a pair of virtual reserves. Inside the range, trades still obey X times Y equals L squared. But now L, the liquidity, is much, much larger. Here's the payoff. Same capital side by side. V2 spreads it across every possible price. Thin everywhere. V3 concentrates it into the range you pick. At the current price, V3 is 16.4 times deeper, 16 times more liquidity for the same dollars locked. Less slippage for traders, more fees for you. Now apply this to stablecoins. $1 plus or minus half a basis point. The capital efficiency becomes 4,000 times. That is where Uniswap's famous 4,000x claim comes from. But there is a price. Out of range, your position earns no fees and holds only one asset. And inside the range, impermanent loss is amplified, roughly fourfold. Narrow ranges behave like limit orders, high risk, high reward. So V3 made the hyperbola smarter. But what if the hyperbola isn't the right curve at all? Uniswap's XY equals K is a hyperbola. The ideal peg would be a straight line, X plus Y equals K. So what lives between them? Here's the line. A perfect peg, zero slippage. But if anyone drains one side, the pool is dead. Curve StableSwap invariant blends the two, controlled by a single parameter A. Small a looks like Uniswap, a full hyperbola. Large a flattens into a near line. Most of the slippage simply gone. Here's the payoff. A $1 million stablecoin pool. You trade $100,000. On Uniswap V3, you lose 909 basis points to slippage. On Curve with A equals 100. Just 5 basis points. 180 times less slippage for the exact same pool size. And Balancer generalizes further, weighted geometric means of any number of tokens. 50-50 reduces to Uniswap. 80-20 gives you an index fund that rebalances itself. One equation, many protocols, but the same math shows up somewhere very different. One equation, 5 protocols, but this math has a twin in a much stranger world. Let me show you 3 ways. Balancer prices its pools with a weighted geometric mean, a product of balances each raised to its weight. Take the log, a weighted sum. Exponentiate, a softmax family. The formula DeFi uses to price an index fund lives in the same family as the softmax transformers use for attention. Uniswap V3 concentrates liquidity into a price range, a hard window. Attention concentrates into a few tokens, a soft window, both. Mass where the signal is. And the impermanent loss curve? The same bowl shape you find in a neural network's loss landscape. Arbitrageurs slide to the bottom in seconds, paid in dollars. Gradient descent slides there in hours, paid in labels. Same machinery. DeFi is not an island. It runs on the same math, all the way down. That was episode 5. 1 equations on XY equals K. 5 protocols and a bridge to AI. Every flavor of DeFi market making, bent from this single curve. But every curve has a dark side. Next episode, what happens when the math breaks? MEV sandwich attacks, and why speed is money on chain. The slippage curve from section 3, exploited, ordered, extracted. If this changed how you see DeFi, subscribe for more. Until next time.